Great, thanks everyone, and good afternoon. So thank you very much for inviting the RBA to speak once again at this year's event. I think it's fair to say we sit here at a time of strength for securitisation in Australia. 2024 has emerged as the strongest year for issuance in over a decade relative to the size of the economy. And you can very much see, I think from the first slide here, that very much frames the discussion today, the strength that we've seen. So the market's been underpinned by strong investor demand, which has driven spreads lower despite high levels of issuance. Today I'm going to take a bit of a step back and do a bit of a stock take, covering why securitisation continues to matter for the Australian economy, how the market's evolved over the past decade or so, and whether we should be worried about any systemic risks related to securitisation markets. So to get to the punchline up front, securitisation is evolving. It remains a stable source of funding for credit and has shifted in three interesting and important ways. We've seen issuance has increasingly come from non-banks. The composition of borrowers has broadened towards those who have less access to traditional bank credit. And we hear from Liaison that investor demand has been supported by increased participation from foreign investors. So it's an interesting picture. What should we make of these developments? We've got three observations. First, they've allowed more households and businesses to borrow, especially some that have less access to more traditional credit from more traditional lenders. And you can see that particularly in those who can't easily provide the usual sorts of income verification and also areas such as vehicle financing. So in that sense, the securitisation market is continuing to support a flexible, it will be a flexible source of market-based funding that supports a diversity of lenders and borrowers in the Australian financial system. So that's valuable for competition, it's valuable for innovation in the market for household and business lending. The second observation is that this shift alongside favourable market conditions does give rise to the potential for some risk to build up in the system, leaving it a little bit more vulnerable to a shock. In particular, in servicing a broader group of borrowers, non-bank lenders have increased some types of higher risk lending. But in other ways, risk exposures have actually declined, and overall there are limited signs of strains amongst borrowers so far. That in part reflects the resilience, of course, of the Australian labour market, which has supported both household and business borrowers, and more generally, any risks to the broader financial system remain fairly contained by the small size of the non-bank sector. And then the final observation on these changes is that there's a pretty interesting picture around investor demand. There may be a cyclical element to the strength in demand, which could turn if we saw global financial conditions start to deteriorate, and that's particularly the case with risk premiums being fairly compressed across many markets. But there also does appear to have been a broader structural deepening across different parts of the Australian bond market, which is playing out. So having given those headlines, I'll now turn to each of those themes. Securitisation, firstly, has been a resilient source of funding for credit provision for the Australian economy over recent years. Securitisation, as you know, helps to fund loans to Australian households and businesses by packaging up those loans and selling them to investors as marketable securities. As you can see on the graph, the share of housing credit funded by securitisation has been broadly stable at about 6% of credit over the past decade. So that's much lower than before the global financial crisis, but the steep increase in securitised credit that we saw in that period was, of course, highly unusual. So at this high level, it's a remarkably steady picture. The resilience of securitisation, though, in recent years is quite striking when you think about the headwinds that the market has faced over that time. And the first of those has been rising interest rates since 2022. And those have tended to make wholesale sources of funding, such as securitisation, less competitive compared with deposits. And that's in part because not all deposits pay interest, and also because deposit funding tends to reprice at a slower pace than funding in wholesale markets such as securitisation. Another potential headwind to securitisation markets recently has been the resumption of bank bond issuance with the end of the term funding facility. I think if we rewind to last year, there was definitely some question over whether the rebound in bank bond issuance that was expected at that time would crowd out demand for asset-backed securities. That crowd out hasn't eventuated so far, and issuance in the markets remains strong, and I'll come back to the reasons for that later. So how has the market remained steady and resilient? Well, one factor has been the flexibility in securitisation business models, which has seen some fairly important changes in the shape of the market. You see that in this graph, that particularly in recent years, we've seen a lot more lenders entering the market, particularly non-banks. So the number of non-banks issuing ABS in Australia in the past year has risen about fourfold compared to when you look a decade ago. So there's been a lot of market entry in that time. And the result of that is that non-banks have accounted for most ABS issuance in recent years, and indeed much of the growth in the market in that time as well. So securitisation is a particularly important source of funding for non-bank lenders, given they can't raise deposits, and we see that, for example, with residential mortgage-backed securities, which make up about 3/4 of funding for Australian non-bank mortgage lenders. Now, that said, securitisation does remain an important source of diversifying funding sources for the Australian banks, and we particularly see that for the smaller banks. So this growing role of non-banks within the securitisation market, it's not unique to Australia. We do see it in other advanced economies, and that reflects a whole range of factors from demographics through to regulatory reform since the global financial crisis. The shift towards non-banks in the Australian market is closely tied to the flexibility of non-banks' business models. And we can see how this flexibility has played out when we look at residential mortgages, and these are, of course, still the staple of the Australian ABS market, with RMBS accounting for 3/4 of the market. You can see how that's played out in this next graph. So this shows the effect that non-banks have had on the mortgages underlying the RMBS market. And I'll step through the graph, there's a bit in there. So what we're comparing here are the characteristics of mortgages that underlie marketed RMBS. So those are RMBS sold publicly to investors, that's the orange lines in the graph. And that's compared there with loans that are in self-securitisations, and these, as you'd know, are the structured assets that banks create exclusively to use as collateral with the RBA's facilities. So these self-securitisations tend to closely reflect banks' overall mortgage portfolios when you look at some important dimensions. And this comparison is all possible from the securitisation database that we use. So broadly what the graph is doing, it's comparing the characteristics of mortgages that are funded in the securitisation market with those that are funded by the banks. And the key takeaway here is that residential mortgages funded by securitisation have shifted towards investor loans and towards low or alternative documentation loans, which require less or alternative verification of income or assets. And you can see that on the left-hand panels in the chart. Now, this mostly reflects non-banks having an increasing share of the market over time, given that they target their lending to these segments of the market. But non-banks have also increased their share of their portfolios targeted to these types of lending over time. At the same time here, you can also see that banks, their broader mortgage portfolios have shifted a little away from low and alternative documentation loans and a little away from investor loans, and that's the blue lines in the graph. So what we see here is that securitisation has broadened towards some household borrowers who might have less access to credit from traditional lenders. That's a long-running trend. It starts before the recent rise in interest rates, and if anything, it's stabilised a little bit lately. So as I'll come to below, on the surface, that might suggest some shift towards riskier loan segments underlying the market. But it's worth also pointing out there's been a shift away from high LVR lending, loan-to-valuation lending, and also a bit of a shift away from interest-only lending. And that would work to reduce risks, which you can see in the right-hand panel. And we've seen a similar shift there in the banking system. So that's the picture on residential mortgages. If we look beyond residential mortgages, we again see that the securitisation market has extended credit to a wider range of borrowers against a wider range of collateral. And there we go. And non-bank lenders in particular have extended their presence to areas such as vehicle and equipment lending and some lending to small and medium enterprises. And again, these are areas that we see and know are less serviced by traditional finance. So securitisation for loans for vehicles has grown very quickly in recent years. You can see that in the chart, and that's partly from non-bank securitisers taking over existing vehicle loan books after several banks withdrew from auto financing in 2021. Now, while there's been quite a lot of focus recently on this strong growth in other ABS, I should point out these are currently still very small numbers when you think about the scheme of overall credit in Australia. For example, business credit from non-bank lenders that do fund themselves mostly through securitisation, that accounts for around 1% of overall business credit. So we do need to keep in mind the size there. So what explains the flexibility on the part of non-banks that we've seen? Well, non-banks tend to focus more on certain parts of the market where banks have more limited risk appetite. And that's That difference in risk appetite, that reflects a range of factors which includes, of course, prudential capital requirements. Non-banks are not directly bound by the same prudential requirements as banks, precisely because they don't take deposits. And as a result, they have more flexibility to extend loans based on their business models and risk appetite around lending standards. Banks do set limits on the risk metrics for loans funded through their warehouse facilities that they provide to non-banks, but even so, non-banks do have greater flexibility in extending credit. So in all, this changing shape of the securitisation market that you can see in this picture speaks to some of the potentially beneficial roles that it can play in the Australian financial system. Securitisation provides market-based funding to a diverse range of lenders that in turn provide important competition to bank-based financing and reach some households and businesses that have more limited access to traditional bank credit. So having talked about those developments, I'll now turn to the potential risks. Strong demand for ABS is, of course, good news for both ABS issuers and for borrowers, but any increase in risk appetite may also come with risks to investors and also to the broader financial system. What we've seen historically in Australia is that the performance of underlying collateral has underpinned the strength of the Australian securitisation market over a very long period of time. As you'd know, investors in rated Australian RMBS have never suffered any credit losses from these investments, and that's partly because losses on the underlying loans have been extremely low and have typically been covered by income remaining in the mortgage pool after required payments have been made. Now, our assessment at this forum a few years ago was that loans funded through securitisation appeared to be no riskier than the broader population of mortgages in the Australian financial system when you look at some key measures. But as I've just shown, there have been some important shifts in the composition of the market, which does warrant revisiting that view. So what do we see? Well, so far, arrears for mortgages underlying RMBS seem to be very similar in their performance to that of mortgages that are extended by the banks. Now, as you'd expect at this stage of the economic cycle, we have seen arrears rates rising, but they're not high when you look at a historic or international perspective. So at this stage, it's not obvious that the relative risks of RMBS have shifted noticeably. We have a good picture here of mortgage arrears, but it is harder to see how business loans underlying ABS are performing. And that's because while we can get great insight to mortgage arrears from our securitisation database, data on non-banks business lending in particular is much more limited. Now, a side note here, I do understand that the ASF's been working to standardise data reporting for SME lending, particularly to better support investors in managing their exposures to these products. So I think that's an interesting development. Even so, this is where liaison that we receive from the market is particularly useful, and we hear that stress is emerging in some areas of business lending. That includes the construction sector and for borrowers who are lower rated, particularly for vehicle financing. But the key message is that those areas are small and they're isolated, and generally investors don't expect them to become more widespread at this stage. Now, this picture of arrears and stress, I do want to emphasise, of course, that's not to downplay the pressures that we know are felt across the community from high inflation and from restrictive monetary policy. So even though the share of borrowers that are experiencing severe financial stress that we see here is small, we do know that many households and businesses continue to experience pressure on their budgets, and that's very much been a consistent theme of the RBA's financial stability reviews. So the performance of underlying loans will affect ABS investors differently, given the distribution of risks is going to depend on individual portfolio choices. And one thing that's important is investors themselves should be well placed to test how those investments would behave under different scenarios. Investors in RMBS tend to be sophisticated, and we could expect them to be well placed to understand and manage the risks that arise from these investments. From a central bank perspective, we're interested not only in the risks to individual investors and lenders, but also we have a responsibility to monitor the potential risks from a system-wide perspective. And a buoyant securitisation market could mean a shift in lending in the system into riskier lending as a whole. The key point I want to emphasise there from a system-wide perspective is that risks from non-bank lenders are currently somewhat limited by the small size of the sector, limited connections into the rest of the financial system, and also their funding being mainly sourced from sophisticated investors, as I just mentioned. But markets evolve, and it's always worth monitoring a number of risks. One thing we do monitor is banks' exposures to non-bank securitisers through warehouse facilities. Banks impose lending standards for the loans in those warehouses that they fund, in line with their own risk appetite, APRA's capital requirements, and RMBS reporting requirements further enforce discipline on loan quality. But the key picture there is that exposure remains very low at around about 1% of bank assets. I'm sure a question on many minds is around the future, and if economic conditions were to worsen, there are also important mitigants against any systemic risks arising from non-banks mortgage lending. These points were discussed more broadly in our recent financial stability review, but I'll point to a few. First and foremost is the resilience of households, supported by a robust labour market and sizable savings buffers. We also know that the vast majority of borrowers continue to have a lot of equity in their homes thanks to prudent lending standards over many years and the increase in housing prices also over many years. And that overall limits risks to the financial system. Very few loans that are in arrears as a result of that are estimated to be in negative equity, and indeed saw this a moment ago in the 4-panel chart that the share of high LVR lending is very low. So while selling a property is usually a last resort, it's very disruptive solution for the borrowers involved. Almost all borrowers in that situation would be able to repay their loans in full. So what's the takeaway here? Well, while there's been a potential for risk to build up in the system, there's limited signs of strain so far, and in any event, the picture is that it would be fairly contained from what we can see. Okay, so far I've focused on the issuers of ABS and also on the ultimate borrowers whose loans are funded by securitisation, but there's also been an important evolution in terms of the investor base that we see in ABS. And as I mentioned at the start, if we rewind to 2023, a major question mark over the market was how investor demand might respond to banks resuming bond issuance in the lead up to the end of the TFF. We know, and you can see in the grey shaded area there, that during the pandemic and with the TFF in place, there was a period of very little bank bond issuance. And that saw investors shift into ABS as a substitute, and ABS issuance by the non-banks increased quite rapidly. So yeah, you can see that in the shaded area there. So a question that some people asked last year was whether the rebound in bank bond issuance that was expected at that time might crowd out ABS issuance. But that crowding out hasn't eventuated. What we've seen, in fact, is that issuance in the ABS markets continue to be strong, even as banks have very much returned to wholesale funding markets. The strength of investor demand meant that pricing has been tight, even while there's been record levels of issuance. And tighter pricing has particularly been noticeable when you look at the riskier tranches in RMBS. You can see on the graph here that the gap between the highest rated prime RMBS and the mezzanine tranches, that difference in pricing is around about its decade low. Now, a key message that we hear from from many is that offshore investors have contributed, at least in part, to this overall strength in demand. And one thing is that market commentary suggests around half of RMBS orders have been from offshore accounts in the first 3 quarters of 2024. Foreign investor demand has been particularly strong in those riskier tranches that I spoke about a second ago. That said, what we do see from the graph here is that foreign ownership of ABS has been relatively stable in aggregate if you look over a number of years. One thing we hear quite frequently through liaison is that some of you are concerned about how persistent this foreign investor demand may prove to be. And if you look more broadly, we've seen a narrowing in risk premia that's not unique to the securitisation market. We've seen compressed risk premiums in a number of markets for risk assets. If you look at the equity risk premium, that's at its lowest level in a few decades, and spreads on non-financial corporate bonds, those have also tightened this year. So we've seen this compression in risk premiums much more broadly. The RBA's recent financial stability review pointed to low risk premiums globally as a potential vulnerability for Australian markets, and that's because they potentially leave global asset prices sensitive to a variety of potential shocks, and that includes if expectations for a soft landing in the global economy were to come into question. That said, if we look over a longer horizon, there do appear to be structural factors supporting demand in the Australian market. And we see that again in other segments of the Australian bond market as well. If we zoom out for a moment from ABS and look at the broader fixed income market, that's a consistent message again we hear through liaison. The development of the domestic bond market has deepened in recent years in a much broader sense. One area where we see that, for example, is in corporate bonds, and I'm using a broad definition of corporate bonds here. This is financials and non-financials. And what you see here is that Australian companies issue a similar volume of bonds offshore now as they did about a decade ago. And at that time, offshore issuance was the bulk of issuance. But in that time, their bond issuance domestically in Australia, that's doubled. And they now issue around about the same volume of bonds domestically as they do offshore. So that's quite a change in the picture. There has been a cyclical component to this, no doubt, but Liaison also suggests that structural supports come from more involvement from Asian investors and also domestic super funds. So with more issuers participating regularly, a deeper pool of investors, we've heard that this has become a bit of a virtuous circle of liquidity where liquidity brings more liquidity in itself. And that's as connections deepen and the market becomes more attractive to both issuers and investors. So that deepening of the domestic bond market, as I said, may be part of a broader trend where liquidity for new issuance, investor engagement, has supported demand for all Australian fixed income products, including ABS. Now, we do need to keep this in context. Australian issuers, as you can see here, have over many years raised capital directly in offshore markets. But a deepening in the domestic market is a welcome development. It supports a more diverse range of funding sources and greater wholesale market access. So it's a benefit for both issuers and investors. Okay, so let me take stock and conclude. Where are we and what's next? Well, securitisation markets have been resilient and market conditions have been very favourable for issuers this year despite some key headwinds. Over the past few years, we've seen a broadening of issuers, a broadening of borrowers and a broadening of investors. And how these trends continue to play out from here is going to shape the market in important ways in the period ahead. And there will be many interesting questions. I think one is, to what extent will the market continue to provide competition for the Australian financial system? If the past few years are any indication, securitisation is going to continue to be an important source of funding for some non-bank lenders. That includes many, those who may wish to expand their lending activities beyond into markets that are less serviced by the banks. The extent to which they do that and extend further into those markets will depend on a range of factors, including demand for this type of lending and funding conditions more generally. Another important question is, how's the market going to weather an evolving economic environment? Much of the outlook for securitisation and the market will depend on the continued strong performance of the underlying collateral and the lending standards of issuers. And then I think the third important question is, will a deepening of the investor base help foster the longer run growth of market-based financing in Australia? While some of the strong investor demand we've seen for securitisation might reflect global cyclical factors, be influenced by conditions offshore, a structural deepening in Australia's fixed income markets does also appear to be playing a role here. So we'll continue to watch these developments with a lot of interest in the period ahead, and thanks for your time, and I look forward to welcoming your questions. Thank you.
I'm not sure if people can hear me. There we go. We do have some questions, and a reminder, if you want to post a question, please use the app. So a slightly longer one here. If some assets are moving from banks to non-banks, will we get a corresponding decrease in senior unsecured bank issuance? And if so, does that have any concerns for local market liquidity and benchmarking?
Okay, there's quite a bit in that question. So, yeah, I mean, I don't know that I would draw those direct linkages quite so much. I mean, I think in any financial system there's a role for both non-banks and banks, and they occupy different parts of the market. Have different risk appetites, and that's by virtue of banks take deposits, whereas non-banks don't take those deposits. So I think that's probably the first point I'd make. There's in terms of whether there's a shifting between the two that broadly raises any concern, I think that there's a role for both in any system, and they both have a natural place. As to how the banks fund themselves, I mean, they have a variety of funding sources. How they choose to fund their balance sheets depends on a whole range of factors. So I don't know that I would necessarily quite draw a stronger link there to to those non-bank markets. I think really it's up to the banks and the non-banks to find the optimal way of funding themselves.
Thank you. We have quite a specific data question here. One of your charts had 6% of all credit was securitisation, I think is the question. Does that count include retained bond issuance of ADIs?
Retained bond issuance in terms of marketed securities, the answer would be yes. If the question is self-securitisations, then the answer would be no. So, yes.
Thank you. Very clear. Got time for another question. Do you have a view specifically on supply of credit to the SME sector? Is there sufficient availability?
Yeah, I mean, this is a long-run challenge, I think, and it's not unique to Australia. I think it's been a source of discussion over many years. We know that SMEs have more difficulty raising finance when you compare with larger firms, but there's a whole host of reasons for those, and some of them do come down to risk assessments and relative risk assessments. It's whether that's the right level of financing, I think is difficult to tell, because you do have lenders having to make economic assessments based on the risks. But it's been something the bank's been quite involved in over the years. Every year we have a panel with small business to understand their access to financing. Of course, we speak to the banks about it in liaison. So it's definitely an area of interest to us. I think one thing that Brad Jones, one of my colleagues, talked about earlier in the year, which goes to this at some level, but kind of links it just to the broader outlook for the Australian economy, is that as a financial system, we're really set up to lend against hard assets, and that's the things you can stub your toe on or drop on your toe. There's much, and if you look forward to the sorts of opportunities that we might have as an economy and the sorts of innovation that often is driven by a small business, that has a large intangible element to it. And so I think there's a big question there on, are we set up in the right way to be able to lend against those intangible types of investments that in the modern economy are often the source of innovation and productivity? So Brad spoke quite a bit on that topic, and I think it does tie to the SME question.
Thank you. I think we've probably got time for one more question. We've got lots of questions piling in, actually, but we'll see how we go. Has the Bank of Mum and Dad reduced the responsiveness of interest rates on house prices, i.e. parents assisting their kids? Rates question for you.
I mean, when we look at the transmission of monetary policy, we're looking at the effects on the broader macroeconomy. We're not targeting house prices. And if you look at how transmission of policies evolved over time, and Chris Kent has given a few speeches on this over time, there have been changes in the transmission of policy, but those have been more around, I think the major factors really been the prevalence of fixed rate lending that we saw during the pandemic. And so that affected PASA, at least through that sort of channel of monetary policy. That's largely worked its way through. So I don't think we would be pointing to any sort of differences as a result of those sorts of factors.
And to make it a little bit topical, we will squeeze one more in. It's just popped up. How are you factoring in effects of Trump into market evolution?
Yeah. So I mean, this question comes up in just about every forum these days. Look, it's too early to really know what the effects are going to be of the new US administration. It's early days. And there's going to be a lot of moving pieces. I think one of those clearly is going to be, what will the new US administration actually choose to do in a policy sense? We don't really know that yet. And at least important, if not more important, is going to be how do others around the globe respond to those policies? So there's a fair bit of uncertainty there, and we'll need to see how that all plays out. I mean, the movements we've seen in markets so far have been pretty orderly, and they're looking at these same things. For Australia, we're a small open economy, so the global trading system is important to us. We've benefited from the liberalisation of trade over many years. And so, if we were to see a reversal of broader international trading, and of course China is particularly important to us, as a small open economy, that is going to be important to us, and those sorts of things do transmit through financial markets. But at the same time, we need to keep that in context because, often, policies such as tariffs, that actually results in a redistribution of trade within the global economy. We've got a comparative advantage in many goods and services. We've weathered these sorts of changes quite well as an economy over time, and so there's potential opportunities as an economy to play to our strengths. So look, it's early days. We'll watch, as others do, as to how markets are considering this, but really we just need to wait and see, and does an economy play to our strengths?
Thank you, David. We have run out of time, unfortunately, but please, audience, could you thank David for his keynote speech?